What's going on, guys? My name is D. Anthony with Evolution Traders. In this video, I want to talk to you guys about a problem that a lot of traders have, and that problem is sticking in trends when it feels like you're getting chopped up, right? So a lot of times it feels like the market's not moving. It feels like, you're getting in, you're getting stopped out, so forth and so forth. Let's kind of look at this chart setup and let's kind of analyze it together in real time. These are some moving averages that I use on my chart. Now, for those of you guys who are in Evolution Traders, you guys know that I use what I call the big chart. That chart's got every single moving average that you can have on it. And it's a little bit difficult to kind of read and understand because there's a lot going on. But I find it very, very helpful. And this is a simplified version of that chart, which I think is very, very good for a lot of traders to kind of mimic or follow, so you don't get so stopped up, and maybe you can adjust your size so that you can withstand some of the pullback and some of the range and some of the chop. So what we have on our screen here is a 20 SMA, the 50, as well as the 200. Now, if we want to stay with the trend, because again, remember, we are not smarter than the market. We are not going to call the top. We're not going to call the bottom. That's not what we're in business of doing. All we are in business to do is to identify where is the trend, even when you feel like the trend is choppy or rangy or whatever some of the other terms that the 90% of struggling traders use. But let's identify together using this chart setup, what is the trend? So if we notice right off the bell, and I'm going to draw this line here because this was the opening candlestick here. If we notice right off the bell, we have an immediate push higher. Now notice how we're coming from the 20, the 50, and the 200. We're getting this big push off of these moving averages here. And then we kind of pull back and we put in a new high and then we pull back. Now, at no point in the day today did we ever lose the 50-day moving average. Multiple times we lost the 20-day moving average, multiple times, but we also never lost the 200 as well. So just looking at this chart, would you say that this chart is bullish? Would you say this chart is bearish? Right? I don't think it's going to take a rocket scientist to understand that this chart is in bullish context. It's moving up, even though you have a big range, right? If I was to draw this box, you have a big range where overall the market was going sideways. Now, you take this off. If you were looking at this chart and you're using, let's say, a 20 SMA to take entries, to take exits, to kind of position yourself to be a part of the trend, well, we're getting some setups here long that get stopped out. We're getting a setup here that maybe goes for 1-to-1. We're getting a setup here that would get stopped out, a setup here that maybe comes back down and would stop you out here. But if you notice, everything is above a rising 50-day moving average. So regardless, should you have taken any short setups today? The answer is no. Okay, the answer is no. If you truly want to be on the trend side of things, you would need to be below the 20, the 50, and the 200 before you start thinking about shorting positions. Now, again, this is going to be very confusing because some of you hyper scalpers out there could definitely take a short position off of a high and play it down into support. And then maybe you can take this for a little bit of a scalp here. And I'm sure, you could time this top here. But again, that makes things very difficult because what you get yourself into a habit of doing is trying to always pick the tops, always pick the bottoms. How many times has this happened to you where the market's pushing higher or the market's pushing lower, and then you're thinking to yourself, no, I think this high, the market's going to pull back a little bit, and you get into a trade, and let's say you make money. And then the market pushes higher a little bit later, and then you do the same thing, and then you get stopped out, and you give it all back. And then you think to yourself, well, the market can't go any higher. I'm just going to, take this short position here. We closed below the 20 SMA. Let me go ahead and take this short position, and then you get stopped out. A lot of traders, 90% of traders who fail, are always guessing. You're always trying to anticipate when the pullback is going to be. You're always anticipating that when we pull back, that it's going to be the move, that it's going to be the pullback, right? Or vice versa. If we're in a downtrend, you always think that this bounce is going to be the bounce that you can get into. You don't think the market can go any lower. But if you just use these three moving averages on your chart, it's going to keep you on the right side of the trend. So if we are trading above the 20, the 50, and the 200, we're in bullish context. Now, depending on the gap, let's say, for example, this downwards pull was to close below the 50-day moving average. We'll notice the gap between the 50 and the 200. Is there room here for us to make a trade? Yes. Is there room here into the 200? Yes. Is there room here from the 50 into the 200? Yes. Is there room here from the 50 to the 200? No. This is not enough room to play with. This can be a little bit of a scalp. This can be a scalp. This could definitely be a little bit of an intraday trade. So if we analyze it that way, it's going to keep you on the right side of the market. So instead of looking for short positions here, we're looking for the bounce. We're going to put a stop loss below your previous swing low. So say, for example, we take this bounce setup here. Well, then we're going to use this previous swing low as a stop, and we sit in it. Whoops. We sit in it until you're profitable or you get stopped out. Now, if you get into this pullback, we're still trading over the 20, you use this swing low as a stop. And if you get into this pullback, you use this swing low as a stop. Now, again, everything is clear in hindsight. Yes, I get it. Looking back at the chart now, it's very easy to say that we should have been in long. I get and understand that while the price action is moving and before we see what happened, it's very difficult. But let me explain something to you for all of you doubters, for all of you people who always look for the negative. Because I see you and you guys are on these videos and you guys swear everything's always negative. No one can ever time the market. No one can ever know how to day trade. No one can ever scalp profitably. Blah, blah, blah. Right? Listen to what I'm saying. I don't care what's going on here. Of course, I can't see that side of the chart when the market is here or here or here or here. I don't know that this is going to happen. I get it. But what if you just tell yourself we're above the 20, we're trading in between the 20 and the 50, but we're over the 50 over the 200. I should be thinking long. 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 If you would have just bought into any one of these dips, whether it's this dip, whether it's this dip, whether it's this dip, whether it's this dip, whether it's this red candle, you would have made money. Because what? The trend is higher. Okay. Now, what happens is a lot of you traders try to get in on the short position, scalp this very quickly, and try to scalp this very quickly, and try to scalp this very quickly. Guys, unless you have space, right, like significant space below the 50, just stay with the trend. So use your 20 SMA as your short-term change in trend. Use the 50 as your bias. So if we're over the 50, your bias is long. Use setups off the 20 as your entries. Use the 200 as the complete change in trend for the day. Use a short setup underneath the 50 if you have room. Gap space, gap space, gap space, gap space. So what we would need to have happen is close below the 50, confirm it, then play it down into the 200, take your profits, bounce it, bounce it, bounce it. So again, the 50-day moving average on a 5-minute time frame is your bias. Is your bias long or short? If we're over the 50, it's long. Use the 20 SMA to take your entries. Use the 200 SMA as your change in trend for the day, or bounce it off the 200. Does that make sense? So again, stay on the right side of the trend. Use the chart. The charts and the technicals are your friend. They're not here to disguise you. They're not here to fool you. They're not here to trick you. You know, yes, the indicators are lagging. I get it. But use the trends that you have, the tools that you have to make money. Use the knowledge that you already know to stay patient and be with the right side of the move. Don't try to guess. Don't try to take that quick short position because you know we're trading way up here and I'm going to catch this move. Just relax a little bit, right? Relax a little bit. So again, I'll repeat it one more time. Use the 50 SMA on a 5-minute time frame as your bias. Are we over that? We're long biased. Use the 20 SMA to take your entries. Use the 200 SMA for the overall change in trend. So below that, we're definitely short. Or if we're pulling back into it, we're looking for a bounce or take profit zone. So again, if you use these three moving averages, I think you guys will be on a much better side of the trade, and you guys will make more money, and you'll be more patient, and you'll allow the trades to actually come to you versus trying to force trades. Hope this video helps you guys. I'll see all of you guys on the inside. To the rest of you guys, I'll see you guys on YouTube. Make sure to like, comment, subscribe, and I'll catch you guys all next time.